Hey bosses, how are you doing? I hope you're having a great day. Today we are going to talk about why you shouldn't pay off your mortgage. Hey bosses, welcome back to my channel. Here is Show Me the Money, where I tell you about properties that makes you money, or as in today, about credit that can make you money. And there's two types of credit or credit lines, the good ones and the bad ones. The bad ones is all of the loans that doesn't generate you more money. What I mean by that, credit card, if you're just paying for your expenses, auto loan, you are buying a car, you finance that car, or any kind of personal or business loan that is not contributing for you to make more money. So every time that you have those kind of loans, usually they don't have an asset attached to them. So they are not secure, they are not collateralized. You don't have a collateral there. The bank is only relying on your ability to pay off that debt by the money that you make. That's why usually the interest rates are very high. Here in the US right now, the credit cards can go anywhere from 12 to 24%. So let's say you have $100,000 in debt, okay? And this debt has 12% interest rates. That means that, let me take my calculator here. If you have $100,000 in debt, 12%, it's going to take you 7 years. In 7 years, you are going to have $200,000 in debt if you don't pay for it. So imagine if you had an investment that in only 7 years would double the amount of money that you have. That's what the banks are doing with you. When they lend money to you, they expect either to you to pay back, or they're going to keep increasing the amount that you loan, because that gets accrued and that gets the compound effect, and in the end you have a lot more to pay for. So those kind of debt, the bad debts, you should pay as fast as possible. I know sometimes we are in trouble, we have to use our credit cards. Sometimes we have to have, like here in Miami, it's impossible to rely on public transportation. And since everything is very spread apart, imagine if you are in Key Biscayne and need to go to Fort Lauderdale, the Uber is going to cost you a lot of money. So I understand that sometimes we need to take debt to buy something that doesn't generate us more money, but is going to save us some kind of money. Like if you buy a car, you have to pay for it, you have to pay the taxes, you have to pay gas, you have to pay maintenance. But in the end, if you use it a lot, it's cheaper than public transportation or share apps like Uber or Lyft. So I understand that. But the important thing here is to understand that the bad debt, the ones that have a high interest rate and doesn't generate you money, you need to pay as fast as possible. But you also have the good debt. And the good debt is the debt that either has a low interest rate, or you are going to use it to generate more money. And that's what the mortgage does for you. So if you have a mortgage today in your house of $100,000, okay? You owe in your house $100,000. Today, the interest rate for mortgages, if you have a good credit, it's around 2 to 3%. So let's say 3% per year. Per year, okay? In a 30-year loan. So you have 30 years to pay that back. So During this period, you are paying interest to the bank. Okay, you are paying a lot of interest here to the bank. Not a lot, but you are paying somewhat interest to the bank. You want to know how much interest are you paying? So let's take $100,000 at 3% per year in 30 years. Your payment, your monthly payment is going to be $898. Okay? Your payments per year is going to be $898. So that's time 30, 100,000, 3%, 30 years. Your payment per year is going to be actually $5,101. So that's what you're going to pay per year. In 30 years, you're going to pay $153,000. So if you took $100,000 in your mortgage, and at the end of this period, you are paying a total of $153,000, $53,000 is interest. Okay, $53,000 is interest. So a lot of people say, okay, why shouldn't I pay the bank my mortgage? Why should I pay off my mortgage if I'm just losing money paying the interest? And I'm going to tell you right now. Real estate here in the US, usually adjust the price at a pace about 6% per year, but when you take out the inflation and it's a compound effect, you are talking about more or less 3% per year. That's how much real estate values every year after inflation. So when you take off inflation, what is inflation? Inflation is how much of value your money loses every single year. So if you have an inflation of 2%, you're losing your money is going to buy in the next year 2% less. So you're talking about 3%. So when you are making that decision of paying off your mortgage, you are just telling yourself that you're going to take your money and you are going to invest in an asset that is going to increase in value at a pace of 3% per year. You are investing your money. You have a decision to make. Either you invest your money, you have money, you made more money this month, you got a commission or whatever, you have this money in your hand and you need to decide what to do, what you're going to do. You're going to pay off your mortgage, where you're going to save 3% in interest and make another 3% in appreciation of your asset, or you are going to put that money in another kind of investment that in the long term. Why long term? Because we are talking about 30 years here. 30 years. So that's long term. You are investing at a 3% and saving 3% here in the long term. So that's your decision. What should I do with my extra money? So I'm going to give you another option. The S&P 500, in the last 80 years, okay, in the last 80 years, had an average of 9.8% per year. So in average, when you take from 80 years behind up to now, the average, considering 9/11, considering the crash in 2007, considering the crash in the 80s, in the 90s, everything that happened, the World War II, everything that happens in the last 80 years is still the S&P 500 generated you a compound return of 9.8% per year. So when you have your money right here, and you have an extra money, I have a mortgage of $100,000, and this year I made $100,000 more than what I actually needed. What you're going to do, you're going to you're going to take that money and put in your mortgage. That once you pay off, okay, you're saving $53,000 in interest, and your asset is only going to grow 3%. Or you're going to take the same $100,000 and put in something like the SP 500 that is going to return you 9.8% per year. So if you put $100,000, if you put $100,000 in a 9.8% per year return during 30 years, at the end of this period, you're going to have $1.652 million. $1.6 million. So if you take the same $100,000 and put in your real estate assets, 3%, you're going to have $242,000 plus the 53 in interest that you save. So this plus 53, you're going to have $295,000. You're going to have $295,000 if you put against your mortgage in favor of your real estate asset. And here in the SP 500, you're going to have $1,652,000 minus the 53 you paid in interest here. Okay, so you're going to have $1.6 million. Daniel, but the S&P 500 is risky, can go up, can go down. In a moment of need, I might have to withdraw my money in the down of the market. I understand. But here you're never going to be able to do that. Actually, if the market collapses and you have a real estate property, it's going to lose value, and because you need money, you're going to have to sell it under the market price, so you're going to lose even more money. So I'm going to tell you another thing. What else can you do? What else can you do here? You could have the best of two worlds. You could have the security or the safety of a real... This is terrible. This is a very beautiful board, but this chalk here is terrible to work with. So you can have another option. You can have the option of investing that money in real estate properties that generate you money. So that way you're generating cash flow, which the SP 500 doesn't generate you that much. And you still have a great return. So let's say you put your $100,000 in a real estate property that once rented is going to give you a net of 10%. And I'm being conservative here. You're getting a net of 10% cash flow. Okay, 10% cash flow. And your real estate property is going to value 3% per year as everything else. So when you put your $100,000 in the 3% per year, you are going to have your 200 and something. 100%, $100,000, 3%, 30 years, $100,000, 3%, 30 years, you're going to have your real estate property, $242,000. And you're going to buy a property that's going to generate you 10% in cash flow. 10% in cash flow, you don't need a calculator to do this. You're going to make $10,000 per month. What you're going to do with this $10,000 per year, you're going to pay your mortgage, which is $5,101. This is going to leave you with $4,899 per year. So every year, what you're going to do, you're going to take this money and put where? In the S&P 500. That is going to give you what? 9.8% per year. Why you're doing that? Because you're being safe. You're taking your money that you have extra. You're putting in a real estate property that doesn't oscillate that much, that is not that volatile, and that generates you a cash flow every single month, every single year. With that cash flow, you're paying your mortgage, and with whatever is the balance from the money you're making here, less your mortgage here, you're going to invest in the S&P 500. So if you take $4,898 every single month, every single year, What happened here? All these calculators. If you take this amount of money, okay, $4,899, you invest today, okay, and you are going to invest it every single month. $4,899 you put here, $4,899 you put every single month here, at every single year, at a 9.8 interest per year, return per year during 30 years. In the end, you're going to have another $856,000. So how much money do you have here? You have 856 plus your property here, 242,000, minus the $53,000 in interest that you paid for, and you still have this property that's going to also be a part of your asset, which is another, let's say you financed 90% of it, okay? So $100,000, let's say you put a 10% down when you bought this property. So your property back then, was 111, okay? This 111, 3% per year during 30 years. At the end, this is going to be 269, okay? So you have the money you made on the S&P 500, the money you made on the property that you bought here, less the interest, plus the value of your home, the home that you're actually living in, 69,000. So 856, 242, 53, 269. So at the end, you have $1.314 million. And that's why you shouldn't pay your mortgage. Because if you paid your mortgage, the only thing you would have was going to be this. Your property worth $269,000. So I hope you now make better decision of not paying off your mortgage before it matures. Use your money to invest in something that is going to make you more money every month, so you can pay off that debt and still have a bigger asset at the end. See you next week.